Well, hi everyone, and welcome to the Buffett and Beyond Research Stock of the Week, and we're going over LULULEMON, and this is March 29th, 2025, and here is the logo for LULULEMON, and folks, it looks like an upside-down horseshoe, doesn't it? Well, just to let you know, this is a little secret here, that is an A, and it used to stand for their original name, which was Athletically Hip. So that is an upside-down name you see there on the logo. Used to stand for Athletically Hip, and they kept the logo and changed the name. And remember, folks, aside from that, if you want to walk on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. And let's go over LULULEMON in case you don't know about the company, but there's a few tidbits in here. And they are a designer and retailer of yoga-inspired athletic clothing and accessories, including pants, shorts, tops, and jackets. And the company sells mainly to women, but also has significant men's offerings. And I don't know about the men's offerings, folks. I just haven't seen them. They sell under the LULULEMON Athletica and Avivia Athletica brand names, and their products are sold primarily online through the company's retail stores. 686 stores, Canada, the U.S., because it is a Canadian company, U.S., Australia, the UK, Singapore, China, and it excludes 22 licensed stores and has about 38,000 employees. Now, LULULEMON just came out with earnings, and they're looking at the forecasts, and they say they don't know what the tariffs are going to be like, so they can't give a good forecasting or a good forecast going on for 2025, maybe even 2026. So that's why the company is down lately, but of course the whole market is having a little trouble in here right now. And let's look at Lulu, and this is the 5-year averages right in here. The blue lines are the S&P 500. Green lines are Lulu. And we're looking at the clean surplus. That's what CS means right in here. We're looking at the clean surplus return on equity. And think of this as your bank account. Do you want to put money into a bank account that is paying you 13.5% or one that's paying you almost double that? Well, there is no question there, but we're going to look at this a little bit closer after this slide, and you'll see what worries us right now. So the clean surplus ROE is totally different and totally configured differently than the traditional accounting ROE. And the clean surplus ROE is very unique in that it's comparable not only among companies in an industry, but also companies in different industries. So you can compare Lulu to a steel company, to a nuclear power plant or utility stocks or anything. So that's what's the great thing about the clean surplus return on equity right in here. Now, net income is income after you take out non-recurring items. And what's the non-recurring items? Yeah, the Jaguar that the president owns and the 5 other Jaguars that he has for the kids that are written off to the company. Well, those kind of things are excluded. So the net income, rather than the traditional accounting income, is a little bit different in that it really compares the operations of the company itself. And again, more than double that of the average stock in here. So at 28.3%, very, very nice. Now remember, these are 5-year averages. Okay, revenue. Yeah, you got to have revenue coming in, folks, in order to bring money to the bottom line. And we see revenue here of over 3 times that of the average stock. And that's why LULULEMON can have such great income, is because it certainly does have the revenue. Now, let's go to the individual years, and right over here you can see the net income and the revenue growth, the 5-year averages, but look at what it is predicting for 2025, and folks, that went down a little bit with this morning's earnings numbers, or I'm recording this, and they just came out with their earnings, but it's really the predictions for next year that's hurting them, because we don't know. Remember, a Canadian company, we don't know how the tariffs will affect the net income growth and, more importantly, the revenue growth. Now, what else bothers us? Well, We used to have this stock in our growth portfolio, and we don't have it in there anymore. Why? Because you can see this clean surplus return on equity starting to decline. And once we saw that, well, we have other stocks in our growth portfolio where the clean surplus return on equity is either constant or growing. So when we see a stock that's starting to decline like this, we start thinking, well, what's it mean actually? Well, we'll tell you exactly what it means. It means they are certainly making a profit, but they're making it at a less and less growth rate. So in other words, the growth rate of the earnings are coming down, or slowing down, I should say. And we look for companies that have a 20% or better clean surplus ROE, and we can see the trajectory of this company declining. So the earnings growth is slowing. It's still very good, still very good, but you can see it's slowing. And these numbers of the net income just were reduced a little bit, and probably after this morning, these numbers will be reduced, or at least 2025 numbers will be reduced a little bit. And that's what this is showing us over here. Now, a good thing is, and I'm talking about the net income growth and the revenue growth, you can see how that is slowing quite a bit now, and that's what worries us, this slow growth in revenues and the slower growth in net income. One thing very, very good here, retention rate. They're taking all the money they're making, putting it back into itself in order to grow. Over here, years to pay debt. That's Buffett's rule. And he says if a company uses all the money it's making in order to pay off its debt, how many years will it take to pay off his debt? And his rule of thumb is 5 years or less. Our rule of thumb is 3 years or less. Well, guess what, folks? Years to pay debt is 0 for Lulu because it has no debt. Very, very nice. No debt, and yet it's taken all the money it's making and putting it back into itself in order to grow. So as competition comes in, and that's what we're seeing here, that's what we're being alerted to here by looking at the numbers, and look at these numbers, how they're coming down. We can see that it's competition that's definitely coming in to the company, so they're making less and less of a profit because they have to lower their prices a little bit because of the competition. If competition's coming in, that means they're selling at lower prices. So can their product be copied? And the answer is yes. And that's the another thing that bothers us. If you have a unique product, think a Snickers candy bar. Who's going to come out with a better candy bar than Snickers? Well, Snickers has been the best-selling candy bar for the past 10 or 15 years or so. So this company does not have a moat built around it. Yeah, it's got its reputation, which is very, very good. But other people are coming in, and they can replicate what LULULEMON is selling. So we'll see. That's why it's out of our portfolio. Let us look at how it has done in the past 1 year. Black line is the S&P 500. So the S&P 500 is about, now this is the past 12 months, not year to date. The past 12 months, the S&P is up about 8%. LULULEMON is down about 25% in here. So you can see it's been hurt along with other retail companies. There's a lot of retail companies that are just not doing very well at all. And so these buying of products is not starting, but has been slow for almost a whole year now. And that's the consumer, folks. What's our economy? 60, 65, 70% consumer driven. So when the consumer starts slowing down, we have to be very, very careful because that big R word starts creeping in. And yeah, they call it recession. So that's what they're looking at, and that's what these charts are looking at, and that's why the numbers are going down. And over the past 5 years, yeah, they were doing good, but 2022, you can see they fell drastically. And even though they have an online presence that you don't have to go to the stores, that stock still fell. That bothered us in 2022. Came back again, and now it's way below the S&P 500. Now remember, the S&P 500 and all the stocks in our database have a clean surplus ROE of about 13.5%. LULULEMON has a 20% return on equity. It should be outperforming the S&P 500. But because of the rate of growth is slowing down and competition's coming in, they are selling this stock. So do we want to get back into it again? We don't think so, folks, because if they don't have a moat, as Buffett puts it, a moat built around them, a unique product or one that's very, very difficult to replicate, then we have to worry about being in that stock at all. So we don't think Lulu can differentiate itself except through its past name, which is really what you want, and that's what's keeping them going the stock going very well. But we don't care because the competition is coming in, and Lulu is getting hurt by the competition, also by sales declining. Their sales growth rate is declining. So, folks, that's it for Lulu. It was one of our favorite stocks at one time. We took it out of our portfolio a couple of years ago, and so we will probably just forget about that stock. We don't think, with competition coming in, that it can be the powerhouse that it once was. And the stock market is trying to test the recent lows of about 3 or 4 weeks ago. And folks, it's just not a good day in the market. So go out this weekend, take your mind off the market, be with your family, be with your loved ones. You stay safe. And folks, the market will be open on Monday, and we'll see you right back here in a couple of days.